ask Mark O'Byrne. He joins us live from Dublin. Hi, Mark. Happy New Year to you. Are you still preaching the mania of parabolicism? Is that the expression?
Yeah, I know you like that word, parabolic. But what I said was it could go parabolic, and manias tend to end in a parabolic move up. And I do think that the gold bull market will end in a parabolic move up. But I also said that there was the possibility of a pullback to 1,500.
And you were right. You were right. Yeah.
Yeah, and it did transpire because it was very clear to everybody it was very overbought in the short term, particularly from a trading perspective. So yeah, it has had a sharp correction. We're about 20% below that nominal high, the $15 per ounce. And I think most people who look at it and look at the fundamentals are seeing it as a buying opportunity at these levels.
But I know you think a period of consolidation. I mean, how long might that period last before the trend reasserts itself?
Yeah, it's very difficult to say, and I mean there is even the possibility of further falls. There's no doubt about that. It's interesting. I mean, we're living in very historic, volatile times, and therefore it's important to have a historical perspective. If you look at the gold bull market in the 1970s, it actually rose from $35 per ounce in 1971 to $200 per ounce in 1973. Subsequently, it entered a mini bear market, and it fell from over $200 per ounce to $100 per ounce. So it nearly fell 50% in 1 year. And then subsequently it rose from $100 per ounce, nearly eightfold, to $850 per ounce in January 1980. So there is a possibility that gold price could fall much further from here. I think it is quite unlikely given the fundamentals and the significant investor demand, demand from pension funds, hedge funds, and most importantly, central bank demand. So I think that demand is likely to lead to consolidation at these levels rather than lower levels.
Mark?
But it's important to acknowledge that there are the possibility of further falls before rising prices. Sorry, Lindsay.
Just take us through those fundamentals driving this demand.
Yeah, well, basically we've very broad-based global demand. So we have demand from everything from hedge funds in Switzerland to pension funds in Netherlands, the Texas Teachers Pension Retirement Funds. Some notable pension funds have been diversifying into gold. Very small allocations, 1 or 2%, but even small allocations from large pension funds is quite important in the gold market, because the physical gold market is actually very, very small vis-a-vis equity markets and bond markets and indeed foreign exchange markets. And then indeed there is the demand from central banks and emerging market central banks, and particularly the Chinese central bank demand is very interesting, and given particularly their huge foreign exchange reserves, so people believe that their demand is quite sustainable for the coming years, and people have coined the phrase the Chinese put, whereby when the gold prices correct significantly, there may be Chinese demand because they tend to be quite astute buyers.
Give us a target for the end of the year.
Yeah, we tried to steer clear of price targets, particularly in the short term. Since 2003, we have said that the inflation-adjusted highs, we keep looking at the nominal price of gold in dollar terms, and in 2011 gold rose roughly 10% in dollar terms and 10% in euro and sterling terms as well. If you adjust for inflation in dollar terms, the record high in 1980 is $2,400 per ounce, and we do believe that price is quite likely given fundamentals in the coming years. In 2011, who knows? I mean, I think the nominal high that we reached in 2011, when I spoke to you back in August, I think that is quite possible given the fundamentals that we have today.
Got it. Mark O'Byrne, founder of Gold Core, speaking to us there from Dublin. Thanks so much for your time.
Now,